wealth, or the investing environment. The recent past has seen a lot of pain. How transient is this pain? And what are the long term structural gains? To present a perspective on this, we have Ms. Ashu Suyash. Ms. Suyash is the Managing Director and CEO of CRISIL and is a member of the CRISIL board. She also serves as a member of the operating committee of S&P Global. She leads CRISIL's Indian and global businesses, steering its efforts to deliver high-quality analytics, opinions, and solutions to corporations, investors, financial institutions, policymakers, and governments. Ms. Suyash has spent 30 plus years in the financial services sector. Prior to joining CRISIL in 2015, she served as the Chief Executive Officer of L&T Investment Management Limited and L&T Capital Markets Limited. From 2003 to 2012, she was the country head and managing director of Fidelity's Indian mutual fund business, which she helped set up. Previously, she had several key positions across the corporate, consumer, and investment banking divisions during her 15 plus year stint at Citibank. Over the years, Ms. Suyash has been recognized amongst the top 50 women in business in India and Asia by various publications. Ms. Suyash is a chartered accountant and holds a bachelor's degree in commerce. She is a member of Primary Market Advisory Committee of Securities and Exchange Board of India and the Advisory Committee on Corporate Insolvency and Liquidation of Insolvency and Bankruptcy Board of India. She is also a member of the governing board of National Institute of Securities Markets, established by the Securities and Exchange Board of India. She has a keen interest in the education sector and is on the advisory board of the Chartered Institute for Securities and Investment and is associated with the Board of Studies at NMIMS, that's Narsi Monji Institute of Management Studies, and is also on the advisory board of Asima Charitable Trust, an NGO that provides education to underprivileged children. Ladies and gentlemen, I would request you all to welcome Ms. Ashu Suyash.
Thank you, Nadine. Thank you for those kind words. A big thank you to the Motilal Oswal group and to Ramdevji in particular for inviting me to this wonderful event. It's a great example of the agility of the human mind. Where would one would have thought that such a large conference would actually be done virtually, and that too with such a phenomenal lineup of topics. And when I think of the topic, don't bet against India, there's a lot that goes through my mind. But what comes to the forefront is a very interesting quote from a very famous football player and coach, Bill Shankly. He says, form is temporary, but class is permanent. And to my mind, that in a way is the prelude to what I'm going to be talking about, which is India faces transient pains, but there could be structural gains. Because to my mind, as we get on to the path of recovery, there should be a lot to be gained. So with that, I'd like the presentation to be put up and we can start. I intend covering the macroeconomic backdrop, the broader performance of the corporate sector, and two special themes, which is why we believe that India is not a market that can be ignored. And we'll definitely touch upon how this crisis looks when I look at a 20, 25-year time period from a credit cycle perspective. So can I request for the slides to be put up, please? Okay, I hope you can see the slides.
Yes.
So clearly, the COVID crisis is one that is quite different from the many crises that we've seen. Because when I look back in time, almost all of them, with the exception of the 1918 Spanish flu crisis, were all financial in nature. This one is a human crisis first, and everything else, including the impact on the economy, the business, the financial sector, is indeed a knock-on effect. Also, it has actually put the entire world into deep recession. And when I look at how the numbers stack up in the context of the world, we are talking of the entire world degrowing. And these are the most recent numbers from S&P Global, degrowing by 3.9%. And this is in sharp contrast to the growth of 2.8% last year. We're already midway through 2020. And when I think of what's happening in India, the extended lockdown, the far less fiscal stimulus and policy support, and the time taken for that to come on, uh, has really caused a case where the Indian GDP will contract by 5%. And this kind of contraction we are seeing after 4 decades. And this particular recession is vastly different, because the previous three that I can think about were largely agriculture led, because all three of them was because of failure of monsoon. Whereas in this time, we're actually going to see the agriculture sector do well. So while overall GDP will contract 5%, we will see agriculture do better. In fact, it's expected to grow about 2.5%. And the non-agriculture would degrow by over 6%. And that's something which kind of makes this whole time quite unique. Let's go to the next slide and see what does this mean from an overall next 2-3 year perspective. With the impact of the lockdown and where we were going into this COVID time, because consumption had already begun to slow down, and even the financial sector was already in stress. Unlike the global financial crisis, where pretty much in a period of 12 to 18 months, we were able to get back to the pre-crisis level growth. This time round, we don't think that even in a 3 year period, growth is going to be able to come back to pre-COVID levels. In fact, to catch up to pre-COVID levels, we will need a growth rate of 11%. And with everything that is happening, we really don't see that kind of growth coming out. In fact, we really think that over the next 2-3 years, we will see an average growth of about 7%. So in this backdrop, now let's see what Corporate Inc. is likely to deliver. Let's look at the next slide. So when I look at the performance of India Inc., it's going to be one of the worst years ever from a revenue growth perspective. This chart has the red line indicating the nominal GDP and the way it has been over the last decade. And the black bars indicate revenue growth. Fiscal 20 itself closed for corporate Inc. on a weak note, with our estimates being a degrowth of 1%. With the COVID impact, corporate Inc., and this is an analysis that we've done of more than 800 listed companies, excluding oil and gas and the BFSI sector, we expect revenues to degrow anywhere between 14 to 17%. And this is quite a sharp contrast to what we had seen even during the taper tantrum, where India Inc. was still posting a 10, 11% growth, and the very sharp rebound that we had seen during post the global financial crisis. In fact, even with commodity prices being low, from a profitability perspective, we believe profitability will be even more impacted, and profitability degrowth is expected to be in the region of anywhere between 24 to 27%. And that's largely because of the very, very severe impact on demand. And in some cases, the demand that's gone in the April to June quarter is unlikely to come back. If you think about airlines, you look at the hospitality sector, tourism, the leisure sector, you're unlikely to see a recoup at all on that count. Now let's look at the next slide and look at what this means from a credit landscape perspective. From a credit landscape perspective, with consumption slowing down, the economy already slowing down, and the stress in the financial sector, the second half of fiscal 20 itself had begun to see the credit ratio fall below 1%. Basically, credit ratio represents the number of upgrades to downgrades. And when it's below 1, it means that there are more downgrades than upgrades. This is not the first time we are seeing the credit ratio fall below 1%. In fact, because of depressed metal prices and subdued global demand, even the second half of 2016, the credit ratio had fallen below, as it had in 2013 and 14. As we came out of the taper tantrum, there were plenty of macro issues and liquidity constraints. In fact, this time we are seeing the credit ratio fall below 1 after 4 years. And if I think of just the April to June quarter, the credit ratio has come down to 0.3 versus 0.6 in the last quarter of fiscal 20. The issue here is not that there are plenty of downgrades. The real challenge is that there are fewer upgrades. Also, with the moratorium having been provided and some leeway given in terms of assessing the COVID impact, a lot of actions haven't been taken, and how companies come out of moratorium will provide the true picture of what does it mean from a credit ratio perspective. Net net, the credit environment is one of great caution. Let's go to the next slide and see what does this look like versus the last 20-25 years. This chart has um, plots a number of very important parameters. It plots GDP, which is the green line, NPAs, which is the black line, the CRISIL downgrade ratio, which is the red line, and the gray line, which is the default ratio. And the data on this chart is right from 1995, and therefore covers a number of challenges and crises that the economy and the markets have been witness to. So we faced the Asian and the domestic crisis, which covered the corporate sector and the financial sector. right from 1997 through to 2001. And then we had the global financial crisis, which all of us are familiar with, 2008, 2009, the taper tantrum through 2013 and 14. I think one of the things that stands out for me is during the global financial crisis, and that's if you look at the red line, the downgrade were almost 29% versus the current situation, which is around 7%, versus the Asian financial crisis when the downgrade rate was about 22%. Another important thing to note is such a high downgrade rate does not mean that the default rate is very high as well. And the default rate, which is the black line, you will see even when the downgrade rate was 29%, actually from a default perspective, it was quite low of between 1 and 2%. And when one looks at from a GDP growth perspective, and this is 20 data where we're talking about 5%, and during the Asian financial crisis, you definitely had seen the GDP growth rate somewhere really growing, from a 3 to 5 year percent, and there was an impact even then. What stands out is the corporate leverage levels, which were very high during the Asian and domestic crisis time. In fact, I'd say that was a time where India did actually far worse than the global financial crisis time. And one big difference between the two periods is the leverage levels. Then also from an asset quality perspective, much worse in the late 90s. And also we hadn't yet had a number of reforms taking place. And during the taper tantrum time, uh, corporate India still had higher leverage levels, and banking asset quality had really begun to trend down quite a bit. And that really posed a lot of challenges, which actually ended up hurting economic growth. And we saw a lot of it playing out over the next 12 months, including very, very high NPA levels. As we talk about the way corporate India is positioned, the way the broader market, the banking sector is positioned at this time, with the deleveraging that has happened, corporate leverage levels are pretty manageable. Though I think the stressed asset book, the bad book, the NPA challenges, a lot more needs to be done, and that's something that still needs to be solved for. From an NPA perspective, we are in the amber zone, though we actually see NPAs climbing on account of COVID. In fact, we see them getting back to 11.5% levels, which is going to be a 15-year high and will take us back to this kind of time zone somewhere between the Asian financial crisis and the global financial crisis time. Having said that, the policy measures that have been taken will definitely augur well, especially when you look at a slightly longer time frame. Let's see what that means, and let's go to the next slide. So if I look at all the big policy and reform measures that have been taken, they've really focused on the trend or structural growth rather than getting near-term results. The key thing is to see how the implementation of these continue through this period. The prudent monetary and fiscal stance has really stood India in good stead. Right now, though, there is need for more fiscal support. The reforms like GST, the Jan Dhan Yojana, Make in India, the inflation targeting, and the recent corporate tax rate cut all augurs well from a trend perspective. The reforms, especially the introduction of the insolvency and the bankruptcy code, is a landmark reform because it gives investors a lot of comfort, because pre the IBC, Resolution was a huge challenge. In fact, it used to be a case where more than the lender, it is the borrower that has the upper hand. And it used to take anywhere of between 4 to 5 years for a resolution. It's early days of the IBC, but we're beginning to see a change there. And then when I think about the COVID support from a fiscal package point of view, the Garib Kalyan Yojana, the 3 lakh crore credit guarantee scheme for MSMEs, the moratorium, all of this will definitely help India come out of this challenging environment. Let's now go to the next slide. And in all of this, a very important point that should not be missed is that India remains a very large, sizable, and a relevant economy. It's the fifth largest economy, second largest when you look at the smartphone market, fourth largest from an automobile market perspective. We've seen a 44% rise in online retail over the last 5 years. And definitely, we've seen FDI rise by 13% in 2020. Now, I'd like to go to the next section of my presentation. Let's go to the next slide, please. And I'm now going to talk about two major themes. The first theme that I'd like to cover is the old charm. Let's go to the next slide, please. Let's move. So the first theme is about the old charm. It's about the consumption story that has really played out for India. In fact, it is the consumption story that pulled India out of the global financial crisis very smartly, and we had a V-shaped recovery. This is a very interesting chart, and it's not just about consumption powering India's growth, but actually contributing to global growth. The x-axis plots the per capita income growth from a purchasing power parity perspective, and the y-axis plots the consumption growth. And the size of the bubble talks about the consumption contribution itself. India has grown very smartly by 7.4% over the last 5 years, and second only to China that has grown 7.9%. And if you look at it from a growth rate perspective, from the size perspective, it is very large. And there is no doubt that the developed markets like the US and Japan are anyway much larger and therefore will see a lower growth rate. The important thing is that with a strong growth rate of 7% plus, as a market, we're likely to overtake the UK and maybe even Japan, UK perhaps in the next decade or so, and Japan in 2 decades. And that's something which is important to look at when one thinks about what does it mean from a future growth perspective. Let's look at the next slide. The other thing is around demographics. I think this is a story that everybody talks about. The important thing to remember is the demographics theme continues and augurs well for consumption. What stands out is the 30% young population, but more importantly, the higher share that we have from a working age population perspective, which is much higher, and it is growing versus China. Versus in case of China, we're actually seeing a decline. And even in the US, there is a decline from a working age population perspective. And the working age population is really between 15 and 59 years of age. A little bit of worry, though, is around the labor force participation, which in case of India is only 48%, while it's 71% for China and 63% for US. And the other thing is around the participation of women in the workforce. For India, it remains very low at 21%. A move in these two parameters, in addition to the higher share of millennials and therefore a stronger working age population, augurs well from a producing class perspective, but also a consumption class perspective. Then, when I look at the chart on the right, which talks about how India has progressed, this is from the World Economic Forum, and it's heartening to see the forecast for India, where the low income group, classified as the percentage of population that will earn less than 2.5 lakh rupees, will be down to only 15% from the current levels of 43% in 2018. But I think what is also very important to take away from this is all of this has really come because of the focus on financial inclusion. And as the bottom of the pyramid moves towards the middle class, we're going to see actually 50% of India's population really belong to the top two categories. And this again augurs well for consumption. Let's look at the next slide. The digital wave is fairly recent. It landed on India's shores only the last couple of years ago. But it's something that has really narrowed the divide between rural India and urban India. It has really made education available to a much wider population. And it's also provided access to all goods as well as services to a much wider population. Despite the strong penetration levels, when I think about internet penetration, only 41% of our population has access to internet, though it's growing by 26% and has grown by 26% over the last 5 years. If I think about the smartphone penetration, it's 32%, and again growing very smartly at 18%. And if one looks at the tablet, much smaller but growing very smartly at 11%. Definitely, this is something which will become a very material contributor. And even if you can't read the numbers, the fact is it's really India and China which has strong growth rates, which is shown in green, while most of the other countries are really amber or in the red zone. Let's look at the next slide, and that also tells a very interesting picture. Mobility will be a very important driver as well as rising urbanization. Uh, in India, if you look at urban versus rural, it's a big divide on every count. Even in terms of internet, only 25 per 100 have access in rural India versus 98 in the urban side. Or if one looks at uh, what's happening on cars, it's 16 in the rural India versus 37. Two-wheelers in the 90s versus 143. So it does tell us that as urbanization improves, there will be strong consumption, even on the discretionary side. And if one looks at the growth from 1995 to now, we've seen a significant change that has happened in India from GDP in PPP terms. The contribution of urban India has grown from 2 to 9.2%, from 2 to 9.2 trillion, and that's a very big contributor. At the same time, the urbanization trend has not been as strong as we've seen in China, which has actually literally doubled over the same period. And therefore, the consumption CAGR over the period has been double digit, while for India, it has moved from mid single digits to 7% in the more recent times. Let's go to the next slide. Access to finance is also something that has made a big difference. At the same time, financial services remain underpenetrated. If I look at credit cards, it's just zero point zero 0.04 in India versus zero point 0.5 in China, and more than 2.25 in Japan. But the important thing to note is that we are seeing better growth rates. Credit to the household sector has been a strong contributor to growth in the last couple of years, and it continues to grow smartly. In fact, the share of credit to households from the overall credit pie perspective is about 9.7%, much lower than, let's say, China, which is 21%, or even Indonesia, which is 24%. But the important thing is it's grown over the last 5 years at 14%. And if one takes out this year of degrowth, it perhaps will get back to low double digit levels. Digital payments again has created a dramatic shift. Even then, the penetration is all of 18 in India versus 142 in China. But the growth rates are strong. Let's look at the next slide. And that, let's move to the next slide. That really brings me to the next theme, which is about seizing the second chance that this crisis is providing India. China is today the world hub for electricals and electronics. It has really gained share in global exports. If one looks at it from 5% between 2001 to 2004, it's gone up to 18% share in world exports. And if one looks at what China supplies just from an electricals and electronics perspective, nearly 25% of the world's electrical and electronics equipment comes from China. Even on the apparel side, it's the share of China in world exports is about 30%. And in case of pharma, a whooping 50% when it comes to API exports. And it actually accounts for two-thirds of India's bulk drug imports. And as COVID played out and China went into lockdown mode, it really created challenges for companies and countries all over the world. And I think the biggest call out was on the pharma side. And when we think about India, India's exports uh, are very little to China. In fact, we import a lot more. Our imports from China have grown from 11% to 21%. And we have a very, very large share. In fact, over 50% of electrical and electronic items form part of what India imports from China. Even on the auto component side, it's a sector where we pride ourselves of having done well. Nearly 15 to 20% of auto components India imports from China. Let's look at the next slide, because in a lot of ways, India missed the bus in becoming a production hub for the world. We really ended up looking at becoming the service hub from an IT and ITS perspective. And in a lot of ways, the chart on the left tells an interesting story. The story for China started in 1980. They focused on industrialization, fiscal decentralization, and also financial sector reform. And in fact, countries like Japan and South Korea started off earlier than 1970 itself. India, on the other hand, really, even from a trade liberalization perspective and an industrialization perspective, ended up only bringing the topic up in 1990s. And by then, China had grabbed a very large share. And it's only recently that we started focusing on fiscal decentralization, and also in making our software export zones many more and also far more effective. This actually resulted in a stagnation of the share of manufacturing as a share of GDP for India. It ended up being only 15%, and as well as from goods exported as a percentage of GDP. In fact, India is perhaps one of the lowest when you compare it to some of the other Asian countries, even far behind Vietnam, which has grown extremely well. Let's look at the next slide, and that really talks about why labor, logistics, and investments is very critical if India has to seize the second chance. Uh, if one looks at it, while India has improved from an ease of doing business perspective to 63, it's nowhere close to where China is, or even countries, uh, like South Korea. There's a long, long way to go. But more importantly, if we have to focus on what are our strengths and how can we leverage on it, I think, from uh, uh, the wage bill perspective, from the availability of labor perspective, India remains competitive. The challenge is on productivity and from a skilling perspective. When we track all these parameters, and at CRISIL we track over 100 such parameters, we find that productivity and skilling are two areas where we need a strong focus for India to really seize this opportunity. Also, from a power perspective, somewhere with the inefficiency that we have, we're not able to bring down the cost of power, though it's been an area of focus for many years. I think one of the important points is around logistics. We focus a lot on road versus railways, and therefore the cost per kilometer of transport ends up being much higher for India. It's 44 versus 26 in China, and that actually makes the cost of uh, production and distribution and transportation, even to the port from an export point of view, very expensive in India. In fact, whatever we gain from a wage cost perspective actually completely goes away from a cost of logistics perspective. Also, from an investments to GDP perspective, we've not really seen investments happen from a very long time. And we think that reform in the area of power, logistics, making India a more labor friendly market, and for the government to actually step up investments during this time, especially from not just tech parks but manufacturing hubs with state of the art infrastructure, will go a long way in making India and making it seize the opportunity of becoming the alternative production hub. Because at this point, all over the world, diversification of the supply chain and having a more distributed manufacturing facility is really the big conversation in boardrooms. Let's look at the next slide. So, can COVID 19 be leveraged as India's second chance? We really think that it is possible because we have sectors with established credentials like textiles, auto components, and pharmaceuticals, where with policy and trade push, especially when one thinks about auto components, we believe that India has a good shot. And for this, direct incentives for global players to procure from India is going to be very important and relevant. In textiles, it is something that we have the capability, but we need a strong investment push in this area and competitive incentives from an export perspective and creating those trade parks. And in the area of pharmaceuticals, we need a strong innovation push. We need to focus on R&D for invention of new molecules and also provide players accelerated regulatory and testing pathway. In fact, COVID provides a great opportunity for that to happen. Also, at the same time, it's important for us to focus on the new age sectors, be it mobiles, defense, battery manufacturing. Because when I think about battery manufacturing, an innovation push is what can make it happen. It's really about forward integrated capacities. From a defense perspective, really attract the private sector. And from an electronics perspective, promoting electronic good manufacturing with localization norms coupled with some tax incentives. So, to my mind, all of this can really get us to seize this second chance quite well. Now, let's look at what might be some of the things to watch out for. Let's go to the next section. So, the road to recovery is rocky. For India to return to the growth path, from where it is, it will really be in fiscal 2022. We think we will get mild positive growth in the October to December fiscal, but this has to be only if the monsoons are normal, the pandemic begins to peak out. We don't see a second wave happening because the second wave could mean another lockdown and also a direct fiscal stimulus of 1% of GDP over and above what has already been announced. With all of this, we could see India recovering to 8% in 2022. Nevertheless, looking at a 3 year kind of horizon, we would really see GDP growth being about 7% per year. And this is largely because of the weak base of 21. And in our mind, this time round, services will take longer to recover than manufacturing. And end of the day, it's going to be consumption that once again is going to be that big engine of growth because private investments will take some time to revive. So I'd just like to go to the last 2 slides. Let's go to the next slide. Very quickly, what are some of the things to watch out for? Definitely the risk of the second wave and delay in the vaccine. At this point, we're expecting the vaccine to come in somewhere in the first quarter or the first half of next year. Delays beyond that will definitely create challenges from a demand perspective and it'll be very difficult for plenty of sectors to revive. We also have to keep in mind the rising geopolitical risks and also the deglobalization trends that we are seeing. Every country is really inward looking and focusing on becoming self sufficient. That has a knock on impact from an India perspective. Also, like I said, we're expecting additional fiscal or monetary stimulus, which is going to be important. The financial sector health is something that we would watch out for. Like I said, banking sector NPAs are likely to inch up to 11.5%. Anything beyond that could pose a risk because availability of credit is very, very critical for growth to come back. And the other thing is around rising unemployment. There are a large number of companies that are in the vulnerable sector. And, there will be wage cuts, but if there is wide scale layoffs and unemployment, that would create a risk from a demand perspective and push back recovery. So just going to my final slide, and this is really putting all that we do on our day-to-day basis and what we are seeing in India play out into perspective. Life does give a second chance, sometimes even two. So it's really what you do with that second chance that counts and not the fact that you just missed the first one. And I thought this was a good way to close the presentation on a parting thought basis. Thank you very much. I hope it's been helpful, and I'm happy to take any questions.
Thank you so much, Ms. Suyash, for the valuable insights. We will now have a Q&A session. This will be moderated by MOAMC Fund Manager, Mr. Shrey Lunkar, and joining him would be Mr. Naveen Agarwal, the Managing Director of Motilal Oswal Group.
Yeah, thank you, Ashu, very much for that really insightful and detailed presentation. And it's very topical, very relevant to where we are right now. And so my first question really is that you spoke about the risk of a second wave being a global risk, and we are seeing many parts of the world where after the opening up, we've seen a follow-up lockdown. Uh, a speaker just a couple of sessions back highlighted that while rural India was hitherto, away from this pandemic, we are now seeing several, small towns also getting caught up. We saw Pune getting closed once again. So in the first round, there was this hope that this could last 3 months, this could last 6 months, and then you had the RBI, coming up with moratorium that is getting over in the month of August. Yeah. So, and you talked about a vaccine coming in the first quarter or the first half of next year. When you put all this together, I mean, in the coming next 6 months' time, do we see the pain for the businesses, the pain for households, only aggravating going forward? Because initially you have savings, you have a hope that you're clutching on to. You have a private sector which continues to pay salaries and is not laying off. You have self-employed people. So basically, how do you see the scenarios playing out? Because many of these things are very confusing right now.
So COVID-19 has actually created a loop or a new loop that economies, businesses, and all of us need to come to terms with. I call it the stop, start, stop, restart loop. And till there is a vaccine, we perhaps are going to see this play out in different parts of the world. And I think resilience, or building that resilience into the business and operating model, is extremely critical. And in a way, what augurs well, which is what I covered, is corporate India focused on deleveraging over the last couple of years. So generally speaking, barring those stressed balance sheets and some of the vulnerable sectors, companies do have the wherewithal to wait it out. In fact, I would say across the 35 large sectors which contribute to 71% of the outstanding debt, roughly about half will be in the resilient zone, and another 40% will be in the medium resilient zone. So in a lot of ways, the worst, which is total lockdown, is behind us. And during this time, companies and employees and the broader ecosystem has understood what this means and how to cope with it. So, work from home has become the norm. And therefore, there is better ability to deal with the stop again, the restart again kind of loop. But the reason why I put it out as a risk factor, if indeed it goes out even beyond the first half of next year, then the impact to global demand, the demand in India, what it means for income levels, unemployment, really all the numbers that I put out will be off. All bets will be off in that sense.
True. Also, you mentioned that the banking sector is in a much better shape compared to the earlier crisis, with leverage being low on the corporate side, with reforms being in place, and so on. But having said that, ever since the ILFS episode, we've had HFCs, NBFCs seeing challenges on the liability side in terms of liquidity, in terms of cost of funds, etc. Now, with this 6-month moratorium period, there are some challenges on the asset side. And really, the jury is still out in terms of how the repayment behaviors will normalize to pre-COVID era post the morad being pulled out from the month of August, right? So in that context, last time around we didn't see one large private sector bank getting so badly stressed, one large HFC getting so badly stressed, quite a few NBFCs getting so badly stressed. How do you see the future of these, smaller banks, HFCs, and NBFCs, given the uncertainty relating to COVID, continuing for a while, the liability side challenges being there, the asset side moratorium being there, and now even the equity prices for many of these companies are at a much lower level, and the availability of equity capital, both from private markets as well as public markets, is also much lower now.
Yeah. So I spoke about the banking sector being in a better shape because of the resolution that with the coming of the IBC, the focus on NPA resolution, and most importantly, provisioning. If you think about 2 years ago, uh, you know, profit levels were just enough to cover provisions, and a lot of large public sector banks actually posted losses. So, from that perspective, we have a reasonable good provisioning levels that have happened from a banking sector perspective. The NBFC sector, like you pointed out, has seen stress right after the ILNFS debacle that happened, right? Having said that, from a funding or a liquidity availability perspective, it had just begun to get better when COVID hit all over again. And the moratorium, gave uh, the borrowers the leeway, banks comfort, because in such time nobody was rushing to pull out deposits from banks, and they also have RBI standing as the lender of last resort. The NBFCs did feel challenged because you had the moratorium on one hand and you didn't have moratorium received across board on the borrowings from the banking sector. From, let's say, what we saw in April and May to what we are seeing in June, definitely the public sector banks have started lending to the NBFCs, and providing moratorium where needed. But most importantly, the TLTRO definitely helped, and the announcements from the government from the PCG scheme perspective sent all the right messages. A very important thing to note from a behavior perspective is the retail borrower did not immediately jump to take moratorium. It's more the corporate sector that jumped to take moratorium. So actually, it speaks volumes from a borrower behavior perspective. And even there, you definitely saw more stress on the unsecured lending book from a retail perspective, not when it came to mortgages, not when it came to gold loans, uh, etc. And even when we think about vehicle finance, because livelihoods depend on the commercial vehicle sector, there will be delays, but they will want to honor their obligations. So from that perspective, as long as there is a calibrated approach coming out of the moratorium, the financial sector will kind of remain in that zone. It won't normalize. We're talking about stability and resilience versus being robust. And one of the things that we at CRISIL have been talking about is perhaps a one-time COVID restructuring, especially for viable businesses, because that will go a long way in alleviating any credit freeze or any wide-scale defaults that would go and uh, hurt the markets, hurt the country, and actually push out recovery even more.
Thanks, Ashu. Shrey, please go ahead.
Yeah, hi, ma'am. Thank you for this. Ma'am, if you look at the last 20 years, the first 10 years was all about leveraging up. And it's amazing how in the last 10 years, the perception of debt has changed completely topsy-turvy, and now debt has become a bad word. And since the last 10 years, succeedingly every year, we have just delevered. Do you think the way we overextended the leveraging cycle way back in 06, 08, do you think are we overextending the deleveraging cycle now? And coupled with the fact that leverage is also low and interest rates are also low, how does the mindsets, how long do you think the mindsets will change towards the perception of debt?
So I'd say the fact that corporate India deleveraged is what is going to help it withstand the current crisis and emerge out of the pandemic in reasonable shape. And the deleverage has to be looked at in the context of capacity utilizations, nowhere being close to the peak levels. So you can't have leverage for the sake of leverage. And with demand having been impacted so severely, we were anyway in a weakening demand situation pre-COVID, and COVID has kind of created a kind of a negative situation. The need for leverage in the near term uh, is not that much. It is more from a working capital and a more BAU perspective. And that's part of the reason I actually believe it's consumption that will result in recovery, and that is what will bounce back, and investments and leverage will follow later. However, I would reiterate that the resolution of the bad book is something that really needs to happen. And that's something that will really help a lot of capacities and groups that are already over leveraged to manage themselves better. And this is particularly stark in the infrastructure sector.
Shrey, you are on mute. You may want to unmute yourself.
I'm sorry for that. Ma'am, we can't let you go without having your views on debt market, given that CRISIL is the oximeter for debt markets. If you can give us your sense, we've been talking about development of debt markets for long. Policy makers have been talking about it, but a lot less walking has happened on that front. Could you give us a sense as to, do you think COVID could be a good trigger point for that to finally happen in the next 3 to 5 years?
Yeah, so my entire career also we've been talking about debt market reform, and I find it really odd that there are so many global investors that are takers for Indian equity, but fewer takers from a corporate debt perspective. In the last couple of years, though, we've seen a lot of positive steps being taken. I think the recapitalization of the banking sector, the introduction of the IBC, and that is, really a landmark reform, which if I look at countries, debt capital markets grew several fold after that because it provided creditor rights and gave that comfort to investors. And that's what I think will happen in India. Also, if you look at it, the inflation targeting framework provides much better visibility on how domestic interest rates are likely to move, because the ad hoc nature has kind of been taken away. And then if you look at it from a risk premium perspective, with our foreign currency reserves being much more buoyant than, let's say, a decade ago, a lot of things look much better. We have moved from being a physical market to totally demat, and a lot more transparency from a price discovery point of view. And the Indian mutual fund sector is much larger now than it was before. So, with all of this, I believe that you will see growth in the debt capital markets. And in fact, one thing that might surprise you is actually, despite COVID, the first 6 months of this year has seen more issuance than the same period last year. So that, in a way, does tell you that we have seen a good movement. I think the casualty has been the number of issuers and the fact that borrowing is still on the high investment grade spectrum. It hasn't yet, forget, sub-investment grade, even a triple B or single A still finds it a challenge. And those are the areas which need to evolve and develop. And I think interesting credit enhancement mechanisms can really rev up that market. And then who knows, maybe in the next couple of years, we'll find our way at least into the emerging bond indices. We're still some time away, though, from the global bond index.
Great, ma'am. Thank you so much for all your time and all your thoughts. It was a great session. Thank you so much.
Thank you very much, Ashu, for joining us today. This is very, very insightful. Thanks a lot.
Thank you. My privilege. Thank you. Thank you, Nandini.
Thank you so much, Suyash, for your time. Thank you, Shrey. Thank you, Mr. Naveen Agarwal.